Think back to 2008. Where were you? What were you doing? Can you even remember that far back? I can't. I had to Google it. There was the Iraq War. Stephen Harper was Prime Minister. Oh, and the Twilight movie series launched. That was a long time ago. So much has changed. But do you know what hasn't changed? Canada's federal corporate income tax rate. Canada's corporate tax rate has stayed at 15% since 2008. Think about that. Low tax rates were justified by the idea that they would lead to more investment. But corporations actually invest less of their profits into production now than they did before the rate cutting began. So where have those savings gone? Corporate cash pools, rising CEO pay, distributions to shareholders. It's not hard to see how the rich have gotten richer and the Canadian public poorer in losing billions of tax revenue every year. The world is a very different place than it was in 2008. Corporations are making record profits and paying less tax. They're also raising prices, which is contributing to inflation and making life unaffordable for Canadians. Raising the corporate tax rate from 15 to 20%, which is still lower than the US rate, would generate an additional $11 billion in tax revenue each year. And that's money that could go a long way in funding social programs and public services to help Canadians at a time when many are struggling just to afford food and housing.